Right now, as we watch the market pulse in real time, the stock price for Opendoor Technologies, Inc., ticker symbol OPEN, is trading at precisely $7.68, showing an intraday decline of $0.055, or roughly 0.71% in the red as of this morning's session. Seeing the stock drift in this $7 range might feel like watching a ship be calmed at sea, aimlessly floating after a violent storm. The expectation for Opendoor has always been one of explosive disruption, the idea that this company would fundamentally dismantle the century-old process of buying and selling homes, replacing the chaotic dance of open houses and negotiations with a simple, clinical, algorithmic transaction. Investors, perhaps even you watching this, look at the aggressive pivot toward AI-driven exclusivities and the sheer size of the total addressable market and expect a rapid V-shaped recovery. You expect that the arrival of a digital-first solution equates to an immediate solving of the housing liquidity problem. However, the reality we are staring at on the chart today is far more stubborn and mathematically unforgiving. What we are witnessing is not a company on the verge of an immediate breakout, but rather a business that is currently being suffocated by the most hostile macroeconomic environment for real estate in 40 years. The slight red tick you see on the screen, down nearly 1%, is a symptom of a market that is losing patience with the growth later narrative and is demanding profitability now. The reality is that Opendoor is fighting a two-front war, one against a frozen housing market where nobody wants to sell, and another against its own balance sheet, which forces them to manage risk with extreme caution. To understand why this $7.68 level is so precarious, we have to look beyond the daily noise and confront the structural paralysis of the U.S. housing market. The expectation leading into this quarter was that lower mortgage rates were just around the corner, which would unlock inventory. Traders using the Robinhood app or monitoring their SoFi active investing dashboards saw the headlines about potential Fed cuts and piled in hoping for a repeat of the 2021 glory days. But the reality is that rates have remained stickier than anticipated, and the lock-in effect is stronger than ever. Homeowners who bought or refinanced in 2020 or 2021 are sitting on gold-plated mortgages with rates under 3 or 4%. They are not moving unless they absolutely have to, due to divorce, death, or job relocation. This means the pool of motivated sellers that Opendoor targets has shrunk dramatically. The institutional investors, the smart money managing massive allocations through Fidelity Wealth Management or heavily diversified Schwab Intelligent Portfolios, understand this dynamic. They know that until mortgage rates drop significantly, likely below 6%, Opendoor's addressable market is capped. This is why you see the stock struggling to break through the $8 resistance level. Every time it rallies, the macro reality steps in and sells it back down. The divergence between the optimistic retail sentiment, often visible in online investment forums, and the bearish institutional positioning is creating this choppy, sideways price action. Let's pause and analyze the strategic pivot, because the company you are looking at today is not the same Opendoor of 2021. The expectation was that Opendoor would simply be a massive flipper of homes, buying high, selling higher. The reality is that this model nearly bankrupted them when the market turned. Now they are pivoting to a capital-light model. This involves the Opendoor Exclusives marketplace and partnerships with other platforms. The goal is to become a platform that connects buyers and sellers without necessarily taking the house onto their own balance sheet. They want to be the market maker, not the inventory holder. This is a smart move on paper. It reduces risk. It means they don't get stuck holding thousands of depreciating homes. However, the market is skeptical about the execution. Can they actually monetize this effectively? Can they convince agents, who historically view Opendoor as the enemy, to use their tools? This transition period is messy. Revenue from the core business is dropping faster than the new revenue streams are ramping up. This air-pocketing growth is dangerous for a stock price. When you are using an interactive broker's trading station to analyze the fundamentals, you see that the service revenue is growing, but it is not yet large enough to offset the decline in product revenue, selling homes. For the individual investor, perhaps managing their own Fidelity brokerage account or experimenting with Robinhood fractional shares, the question is whether this price represents a generational entry point or a value trap. The stock is trading at a fraction of its former sales multiple. It looks cheap if you look at a chart from 3 years ago. But stock prices have no memory. The market doesn't care that you bought it at $20. It only cares about future cash flows, and right now, the cash flow visibility is murky. The burn rate is the critical metric. Opendoor has a decent cash pile, but they are burning it to keep the lights on and develop these tools. If the housing market remains frozen for another 2 years, that cash pile starts to look a lot smaller. This is the existential risk that keeps the valuation compressed. It is not just about growth, it is about survival. Speaking of algorithms, we must address the pricing engine that is the heart of the company. The new management has been vocal about using advanced data science to price homes more accurately and automate the renovation assessment process. The expectation is that Opendoor will become a tech company first and a real estate company second. If this is true, the stock should command a software multiple, which would mean a price 3 or 4 times higher than today. But the reality is that real estate is a stubbornly physical business. You cannot fix a leaky roof with code. You cannot replace a broken HVAC system with a chatbot. There is a physical limit to how much efficiency software can wring out of a construction project. The market is currently waiting for proof. They want to see the unit economics improve, specifically the contribution margin. They want to see that the cost to sell a home has dropped because of these tools. Until that proof appears in the quarterly reports, the tech story is just marketing fluff to the cynical traders on the Interactive Brokers platform. Let's look at the technicals on the chart. At $7.68, we are hovering in a dangerous zone. Support sits around $7.20. If that level breaks, the algorithmic selling could accelerate, pushing the stock back down toward the $6 level where it consolidated earlier this year. On the upside, there is a massive wall of resistance at $10. This is where many bag holders are stuck. These are investors who bought the breakout in early 2025 and are now underwater. As the price approaches $10, these investors will look to exit at break-even, creating a wave of selling pressure. Overhead supply. For the stock to clear $10, it needs a massive catalyst. That catalyst would likely be a surprise cut in interest rates by the Federal Reserve or a sudden spike in existing home sales data. Without that external help, the stock is likely to remain range-bound. This volatility is a paradise for short-term traders. The high beta of the stock, meaning it moves much faster than the broader market, makes it a favorite for those using SoFi Active Investing or day trading on the Fidelity trading platform. You see massive swings of 5 or 10% in a single day on no news. This is characteristic of a battleground stock where the bulls and bears are fighting over every cent. But for the long-term investor, this volatility is nauseating. It requires a stomach of steel to hold a stock that can lose 10% of its value before breakfast because a bond yield ticked up. The comparison to Tesla stock is apt here, not in product, but in sentiment. Tesla went through years of being the most shorted stock on the market before it proved the model worked. Opendoor is currently in that valley of death, where the shorts are betting the model is broken and the bulls are betting the model is just early. Comment below with your own experience. Have you tried to sell a home recently, or are you waiting for rates to drop? Do you think the instant offer convenience is worth a lower price, or would you stick to the traditional market? We also need to talk about the competition. Opendoor is effectively the last man standing in the iBuying space after Zillow and Redfin exited the business. This expectation was that being the monopoly would give them pricing power. They could dictate the spread, the fee they charge. But the reality is that their competition isn't another company, it's the traditional market itself. It's the local real estate agent who tells a seller, "I can get you $20,000 more if we list it normally." In a market where affordability is stretched, sellers are fighting for every dollar. They are less willing to pay Opendoor's convenience fee if it means walking away with less equity. This consumer behavior shift is a headwind. The convenience premium evaporates when people are broke. This is why Opendoor's move to partner with agents is so critical. They need to be an ally, not a competitor, to the traditional system. For those of you looking at online investing sites or seeking investment help, you might notice that analyst ratings on Opendoor are mixed. Some see a 10-bagger potential if the housing market normalizes. Others see a 0. This bifurcation is rare. Usually, analysts cluster around a consensus. Here, the divergence is extreme. This tells you that the outcome is binary. Either they figure out the capital-light model and become the Amazon of real estate, or they slowly bleed out as the housing freeze continues. There is very little middle ground. If you are allocating capital here, you must size your position accordingly. This is not a core holding for a Fidelity IRA.